retirement system to order. The first item on our agenda this morning is the approval of the agenda itself and any announcements. How would the board like to proceed on that?
I move to approve the agenda.
I second that.
Thank you. With a motion and a second, that the approval of the agenda is on the floor. All those in favor, please signify with an aye. Well,
Aye.
Thank you. All those opposed with a nay. Hearing none, the agenda is approved. Next item on our agenda this morning is approval of the April meeting minutes.
Mr. Chair, in
Yes.
announcements, do you mind if I just take a quick moment and
No. Please, Tim, please do.
Okay. I just wanted to take a moment to welcome our newest board member. For the rest of the board, we have Lucas Herring here, who was recently appointed by VSEA. So Lucas, I don't know if you want to just take a moment to introduce yourself to the other board members here.
Sure. Lucas Herring, my current position, I'm in IT Deputy Director working for the Agency of Digital Services. I've been working for the state of Vermont for about 26 years. I actually was on the VSEA board back 15 years or so ago. So I do know the VSEA side of the house, but I also know the management side of the house. So I'm glad to be here. Thank you.
Thank you for doing that, Tim, and Lucas. Thank you for joining us and being willing to serve. Much appreciated. Thanks again, Tim. Sorry, I didn't see Lucas join us. So thanks again for keeping track. So next item on. Yes.
Eric, this is Beth Fastige. I'm on the phone, just to let you know.
Okay. Beautiful.
Okay.
Thank you for joining us.
All right.
Beth F.
Hi, sorry.
Thanks. So with that, the second item on our agenda this morning is approval of the minutes from our April 2026 meeting that were in the packet. How would the board like to proceed on the minutes?
Eric, I'll move approval.
I'll second.
Good to see you too, Jay. With the motion and a second, the item is on the floor. Any discussion on the minutes?
I had a question on item 5. That pertains to in-plan Roth conversions. And I guess the gist of it is that the transfers and rollovers are options, and staff will present this as an option for the board. But a time frame wasn't specified, so I just wondered if Tim could address that, even though it wasn't included on the minutes.
Yeah, sure. At the meeting, I indicated that we're working on a larger restatement process over the next 3 to 6 months. This in-plan Roth conversion option will be presented to the board in that course. I was actually hoping to have it ready for today, but we weren't quite there. So I've got to see how much we have on the June agenda to see if we'll be able to bring it there. I would expect it would either be June or July.
Thank you. No cause for amendment. I just want a point of information. Thank you.
Sure.
Thank you, John, for the question. Any further questions or discussion on the minutes? Seeing none or hearing none, the motion to approve the April 26th minutes as presented is on the floor. All those in favor, please signify with an aye.
Aye.
Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and the April 2026 minutes are approved. Next up on our agenda this morning is public comment. are there any members of the public that would like to make any comments to the board this morning? I do see, there's a couple screens of people. I don't necessarily see anyone from the public, but just if there are members of the public here and you would like to offer any comments, please raise your hand or unmute. Some phone numbers, so I'm just going to give it a minute. All right. Hearing none, I think we can turn it over to Gabe and team here. Unless Tim, you want to tee this up in any way, the next item on our agenda is the 457 plan quarterly review, with Empower taking the lead first, and then we'll hear from RVK as well. Tim, should I turn it over to Gabe or?
I think that's great.
Okay, Gabe and team, floor is yours.
Good morning, everyone. Thank you. Thank you very much, Mr. Chair, Eric, and everyone. It's wonderful to see many of you. Lucas, welcome. Welcome to the Deferred Comp Trustee meeting. My name is Gabe Dulise with Empower. I'm the Relationship Manager, Senior Managing Director. I'm going to share some observations and some statistics on the plan. But we also, just for your reference, we have some additional team. We have Melissa Tremonte and Ryan Markeva. Those are the client service managers that work with your participants and with staff on a day-to-day basis. And then there's Brian Feisick up in the corner up there. He is one of 3 individuals who are dedicated on-site representatives all over the state of Vermont and working with employees about this program. So the Empower team is all here, and you'll hear shortly from RVK and that team as well. So welcome, and please, if you have any questions throughout the presentation, let us know. To all of you, happy spring, happy spring. As in my normal fashion, I'm just going to share a couple of quick observations that we're seeing in the marketplace, and then get into kind of your plan. And of course, at some point, Chip is on vacation, for those of you that know Chip, and Brian Feisick has decided, was graciously stepping in. That'll provide a field report that will kind of just share some some insights, if you will, on what your participants are doing, how they're feeling, and what some of the activities that we are undertaking. As a general theme, I would say, again, not only just for Vermont, but across the board, what we're seeing, boils down to volatility and affordability. And we've had a lot of affordability conversations in the past, given, the markets, et cetera. And, volatility does continue. For example, the first quarter, the market was down, valuation was down, you'll see in a moment, but it has bounced back resiliently, up and down, up and down. And given all of the geopolitical issues that are taking shape, so to speak, it'll probably continue to create more volatility as we move forward. So it'll be important to hear from Brian on what your participants are seeing. Again, what we are seeing at Empower, we've got 20 million participants on our book of business now at about 2 trillion in assets. So we do see quite a bit, and we, like to share some of those themes and trends that we see. What we're seeing now is really an uptick in participants calling up, little anxieties there, wanting to do what we call a registered rep review. Am I doing okay? We're hearing from retirees. Do I need to make allocation changes? Employees, is it a time to buy? Is it a time to sell? I'm thinking about retiring X. Do I have enough? So all of our on-site representatives are engaged with many, many participants on a daily basis, whether it's via webinar or live, in a certain location. But there's a lot of anxiety still out there. It's picked up. I shouldn't say a lot, but anxiety has picked up given all the activity that's happening in the marketplace. So that's pretty much in a nutshell, and then I'll let Brian speak to that later on. I'm going to share the first quarter presentation through March 31st. And I'll give you an idea of, let me see here. Can everyone see my screen?
Yes.
Yes, great. Thank you for that heads up there, just to give you an idea. Okay, so we're going to just go to a couple pages here. I'm not going to go page by page, but as you can see at the end of March, so March 31st, we had 9,600 participants in the plan, representing 793.1 million in assets. Just to give you a flavor of volatility, I just checked this morning. Last night's close was 856.6 million, representing 9,637 participants. So as you can see right there, we've got 7 and 56 and 7, we can do that math, another $60 million pop in valuation just in the past month or so. Representing 9,600 participants, as you can see here, through March 31st. We're going to look at kind of the average account balance, which, by the way, now because of the market valuation, it's at $88,000, $89,000. So in March, it was at $82,000, the average account balance. And looking at our benchmarking between the top and average across the board, we're going to look at investment strategy utilization for those people in the plan. How do they invest their money? What strategy are they utilizing as it relates to the program? And then we look at, and Sarah will get more deeper into the actual investments. But just a snapshot here, you'll see that the majority of your assets are in large cap funds, 33% of the assets. You do have a healthy mix of diversification across the plan. Lifetime income scores, a replacement ratio, where you're at in the average, et cetera, where you fall in. I'm not worried about that too much. You're right in line. But let's look at money that came into the plan. So for the first quarter, as you can see here, we had $9.2 million come into the plan in terms of contributions. We had almost 17 million go out of the plan in distribution. So we had net negative cash flow of about $7.8 million. And you can see quarter over quarter kind of what the impact was. And I want to take you to the change in value line. So as you can see, we've had some really nice growth over the last couple of quarters, but ending on March 31st, it was a down day, obviously, right? So you can see the minus almost $12 million in decrease in net valuation just for that day. So these are a snapshot in time, right? And again, we're up to what, 857 million now. So with the volatility and the flexibility. And we're going to get into some of these additional details as well here. So when we look at contributions, of that $9.2 million, 6.7 of that was before tax contributions, which was pretty standard. Almost 1.9 million in Roth contributions. And again, not only for this plan, but across the book of business, Roth seems to be the most popular place for the majority of new individuals joining the plan as a hedge, for their future years. And we are going to be talking about enhancing the plan, as Tim mentioned earlier, about the potential for the board to consider adding in-plan Roth conversions and things of that nature later this year. Other contributions of $636,000, those are rollovers into the plan. So those are individuals that talk to Brian, Chip, and team and say, hey, I just either came here, I have some outside assets that I'd like to roll into my plan. Can I do that? And how do I do that? Well, 636,000 came in over the quarter. And then below that, you'll see a run rate below month over month. So you could see, it's around $3 million. Let's call it around $3 million. Some months it's higher or lower based on activities. But generally speaking, you get about $3 million a month coming into the plan. As we move forward on distributions, okay, money came in. Let's look at money that went out. 15.3 million came out in the quarter of the 17. Now, that's a combination of a couple of things. That's not just people that left and took their money out. That does include that. But it's also, there's 855 transactions. Those are also individuals that have retired and now are taking installment payments. So they're included in that number. So there are people that are drawing down, using this money as they deem necessary, whether it be quarterly, semi-annual, or annual. So that includes that. The other distributions that came out, there was 100 of those, almost 700,000 representing required minimum distribution, right? Many of you are familiar with that, if not just ask. In-service distributions, hardship distributions, service credit, Secure Act. There was one transaction for a Secure Act transaction of $3,900. Quadro, qualified domestic relation order. Sadly, death distributions, right? There were 31 death cases reported in the quarter, representing just under $400,000. So there's the $17 million broken down by kind of distribution type, if you will. And again, the run rate below looks like my average is probably in the 5 range, with some months being higher than normal. We normally see January usually spikes. And the reason is January is when people usually retire, right? Is when they've retired at the end of the year. So you see a lot of activity in the beginning of the season, so forth. Participants balances, where we are there, and the allocation of that, as you can see, in terms of what distribution balances by balance. It's very common to see smaller balances cash out, if you will. So the 48% of those were account balances less than $25,000. Averages and medium, some statistics there. Now we're going to focus and put some money attached to or dollars, I should say, to the investment strategy. So as you can see, there are about 771 participants that utilize My Total Retirement. That's a fee-for-service professionally managed account. That represents just about $49 million, as you can see there, with an average account balance of $64,000. Then there's free online advice. 50 participants use that tool. Again, 6.41. But when you look at kind of what are people doing? They're doing two things. One, there's your target date strategy. So you've got, almost 23% of your participants, 2,200 of them to be exact, utilizing a target date strategy that represents about 10% of your assets, or $83 million. And then you've got the asset allocation model. For those of you that remember, that was Goalmaker. Goalmaker is the asset allocation model. That's another 2,800 participants, representing $148.6 million. And Lucas, just for your benefit, because you're new here, the Goalmaker is an asset allocation tool that utilizes the investments in the plan, and it's powered by Morningstar. And what that does is, based on what an individual's time horizon is and risk tolerance, it makes a suggested recommendation of investment. And I would recommend, if you're not in the plan, Lucas, I don't know, but if you are not in the plan, please reach out to Brian or Chip and make an appointment to make sure you understand the benefit of this plan, because there are a lot of benefits to it. I do hope you're in the plan and you might be familiar with it. But if not, please reach out to one of the dedicated retirement representatives there to answer any additional question. The other strategies are risk-based strategy and brokerage strategy, et cetera. But the predominant amount of people, as you can see there, the 39%, representing 62% of the assets, are people that do it themselves, right? Which is pretty common for people to do. Some people will use the tools, look at a suggested investment strategy, and do their own thing and tweak it, et cetera. Or some that are very financially versed, like to do their own. I want to do this, this, and this. So there's the do-it-yourself strategy, which continues to be the largest amount of that 800 million. Almost 500 million of that is for individuals that create their own investment allocation strategy. And then now I'm going to get into just some data and statistics. I'm not going to go page by page, but again, we break down active versus people that are separated from service and how they're investing. Key takeaway here is many participants in deferred comp plans continue to stay invested. They continue to stay in the program, whether it be legacy planning, et cetera, because this was voluntary money that they put in, right? And it's money that they're going to use when they want to use and how they want to use it. So, but it's nice to see that a lot of participants who have separated from service continue to stay invested. The days of take all my money and put it in a bank or stable value fund is long gone. Participants talk with their representatives, and Brian will speak to a little bit about retirees and what actions they're taking. So again, it's nice to see a healthy mix of individuals. And when you look at the assets, across the board, there's a substantial amount of probably half, if not more, that are in separated. These are participants that have no longer worked in there, that have separated status or stopped contributing, for example, or have separated altogether, but still invest in the program, which is nice to see. Advisory services, again, these are people that are, now we're going to break it all down. These are people that actually pay for service, and you could see there's 771 participants there, just over $49 million. And then a lot of statistics in terms of your population by age group. What are they investing in and how are they investing? And again, just more data in dollars break down the various segments of how they're investing their money. And then we go into Goalmaker, which is the other asset allocation tool. That's at about 2,800 participants, 148 million. And then we break down the various portfolios, conservative, moderate, aggressive by age group. And then we give you a snapshot here of the investment options and what of those investment options, what are utilized in Goalmaker and what is non-Goalmaker. So kind of show you what those sleeves are, if you will, with respect to Goalmaker options. So break that down for you, more data. And then assets by fund across the investment strategy platform, right? I told you, a lot of data here. So if you want to look at, the bond fund, Calvert's the first one here. You'll see Calvert Bond I, there's $1. That's just a cleanup on data. We changed some share classes. We've made fund share class changes. So there is those $1 or $2 are going to be cleaned up by the next quarter. But the Calvert Bond R6, you can see 4.3 million is in managed accounts. 191,000 was in the online. Do it yourself, 5.7 million in do it yourself, or and brokerage, et cetera, so forth. So we break it all down in terms of the investment options and where what strategy that the participants are utilizing.
Gabe, can I stop you for 1 second there? Just
Of
ask
course,
a question.
Eric. Of course.
So when we look at the funds that have the different classes and the transition between them, I assume those funds are moving towards classes with more advantageous fees for the assets that are in them, or just if you could provide some perspective on that.
Sure. And I'll ask Sarah to opine as well. But the strategy, the share class changes that have been presented with RBK and to the board moved these share classes to a institution, what we call an institutional share class. The result is a lower expense ratio, which allows participants to capture the performance on the right. So these were designed, again, when you build up scale, you qualify for share classes that are more advantageous, but it's based on scale and assets and the fund that you're in. And because of that, you're able to move into a lower share class or a different share class that has a lower expense ratio. So it does benefit the participants. And I'm going to pause there to see if Sarah wanted to add anything. I can't see her on my screen, but if there's anything I missed, Sarah, or would you like to clarify, please do.
No, that is perfect. So 3 funds have moved to a lower fee share class, and this was approved by the board at the January meeting. I could be wrong, or I think Q4 of last year. So the Calvert Bond Fund, the Vanguard Institutional Index, and the Dutch and Cox International were all approved to move to a lower fee share class, and this is based on combined assets across all the supplemental DC plans. So we looked at the combined assets, confirmed share class eligibility, and based on that, we made the recommendation.
Thank you.
Yeah,
I just wanted to confirm that that's what we were seeing there. I appreciate it.
Yeah. And some of this is cleanup data. When you see the little stuff, that's cleanup stuff, but we just try to highlight the different, like, for example, going forward, you're going to see Dodge and Cox, you're just going to see the normal share class, right? And you're not going to see the little cleanup stuff there. But yes, you'll see the one. Correct.
I'll just highlight, this is one of the areas where we get some scale from having one record keeper for all of our supplemental plans, where we do have the 457 is by far the largest pool of assets, but all in, we have substantially more when you count the DC plans, 4 through B plans. And so that scale gives us some additional
leverage.
opportunity to get at those fee discounts.
Scale provides leverage. Absolutely, Tim. Thank you. Yeah. And overall, just so everyone's aware, overall, it's a little over $1 billion that empower on the various plans, your benefit plan. And again, we're just giving you a snapshot of 331 versus 26 versus 25, more data, transfer activity, additional plan insights, quarter over quarter, demographic data for you. And then there's, just some data that we collect based on activity. We use what's called the Empower Communication Engine, which is a very intuitive system. And what it does is it looks at your plan and activities that people take and actions that they take. And we look at, when they enroll in the plan, how they save and invest and how they optimize. And then just some how does your plan compare? For example, I'll just pick one here. How many have set up a personal dashboard? Your plan 10%, peers, top peers, as a benchmark against our company. And how many enroll in managed account? How many are registered their accounts? And then you get some additional stuff, year to date, how many people enrolled, how many people added a phone number, registered, and things of that nature. So these are some good metrics in here that shows the activity. And the bottom line is your participants stay engaged. Your participants stay engaged, and we kind of monitor this on a quarter. And if there's anything that needs, sticks out, we'll obviously bring it to your attention. Or if there's a communication that works or doesn't work, we'll discuss that as well. But again, it's just utilizing technology to tell us what participants are doing, how they're doing it, and then we're looking at those results and how you compare to other peers in the same space. So more data for your reference. And before I just touch on the SDIA, which is the Wasting Trust Account, are there any questions? I know I went through that fast, but I just want to hit the highlights before I send it over to Brian. Okay. On the SDIA, For the quarter, we're at $19.4 million, representing 654 participants. For those of you that may recall, this is what we call a wasting trust. This was a benefit that was provided for many, many years ago for participants. At some point, right now, it looks like there was 455 for the quarter. It's about a $2 million, per year, if you will, coming out of this plan, as we can see here. But at the end of the day, it is invested in a stable value fund. But at some point, I'm sure Tim and staff will be presenting the board and RVK with options on what to do with this plan. Because Tim made an observation. Tim, I don't want to steal your thunder here, but at one point, a couple of years ago, this was like $50 million, and we're down to less than 20 now.
Yeah, no, I just pulled the report from this quarter 10 years ago, and we were at $53 million. So that's come down to below 20 substantially. We were at 1,400 participants. That's down to 646, I think, in this report. So, this is performing as intended, and I think within the next couple of years, we'll be coming to the board with a conversation about kind of how, whether or not it makes sense to move this into something else. I really don't have that solid in my head at this point. But the scale is getting to a point where I think that'll be a conversation I'll have with Sarah to kind of think about what our options are, work with Empower, and then we'll come to you. It's not a front burner, but it's coming at some point.
Yeah, and keep in mind the population in this group is a lot older, so those balances may come down faster than you think. And obviously, it'll, as Tim says, continue to monitor and then make some recommendations for you guys to consider what to do with that plan. So that's the SDIA. So Brian, why don't you share a little bit about participant activities in the field, please? Thank you all.
Yeah, absolutely. Yep. Thanks, Gabe. For those of you that don't know me, my name is Brian Feisek, one of the 3 retirement plan advisors for this plan. So really looking at this past quarter, the dominant theme that we heard was the market volatility due to the conflict overseas. We, especially towards the latter part of Q1, is really when that started to take hold. And we saw a very quick about 10% correction in the stock market. That, again, occurred very quickly. This was the first one that we've seen going back for a few years now, probably back to 2022. When this happens, when we have consecutive years of really good stock market performance, sometimes people forget that the stock market can move both directions. They get so used to seeing gains, every quarter when they open up their statements, that when this happens, it can cause some panic and some angst. So one thing that Chip and I talked about that we were extremely impressed with the state of Vermont participants is we heard from other colleagues on other plans that their phones were ringing off the hook, that people were calling, in a state of panic saying, I think I need to redeem and withdraw my money and maybe move to a safer investments due to what's happening. And that just did not occur here in Vermont. We were extremely impressed with the resiliency that our participants showed. There certainly was an uptick in calls, but there was not that same level of panic that existed here. And I really think that goes back to the maturity of this plan, kind of having that older population. And just a lot of these folks have lived through these corrections before. And most of them know that the best strategy to have when this happens is really just to stay the course, and not panic and not make any rash decisions that they might regret later. So, even though it was a tough quarter, especially towards the latter end, it was really just business as usual for us for the most part. The number one tool that we continue to have at our disposal here when we're meeting with participants, both in person and then virtually over the phone, is this retirement readiness review tool that Gabe mentioned. This is something that Prudential did not have when the plan was with them. So this is a new tool that we've had since we moved to Empower. But this is our way of, when we're sitting down with the participant, to be able to show them, here is what your future retirement is going to look like based on all your different sources of income that you're going to have in retirement. And the reason this tool is so important is I cannot tell you how many times when I'm meeting with participants, someone will come in with a frown on their face, an unhappy look. And the first thing they'll say is, Brian, I don't think I'm ever going to be able to retire. I think I'm going to be working well into my 70s. The way things are looking, I don't think I'm saving enough. I think I started too late. What can you tell me? What words of wisdom can you give? So this retirement review, what it allows us to do is look at all their different sources of income, like I mentioned. So we look at what their Social Security is going to be in the future. We're able to look at their state retirement, what that looks like, any other sources of income that they're going to have. So we look at other retirement investment accounts that they might have, whether that's IRAs or other company 401ks, whatever it might be. We try to add in the balances of those and combine those. And then we also, once we have that overall number, we compare that to what their future expenditures might look like, which of course, hopefully will be lower than what they are now. But in most cases, the great majority of cases, at the end of the day, when we look at these overall numbers, when we add together all their different sources of income, their situation usually is not nearly as dire as what they think it is. When you're adding in Social Security, when you're adding in the state retirement numbers, in most cases, they look at those numbers and they say, wow, I'm actually in a better shape than what I thought I was. And usually they end up walking out with a smile on their face. And one of the advantages of this tool as well is once we enter all this data on our end, it ends up transferring over to their online Empower account. So if they have online access to their Empower account, they can go in and they can now see all these numbers on their end, and they can make changes and edits to them. So if, for instance, the Social Security, if we make just an estimate for them, once they get that more accurate number, they can go in right to their Empower account and update it right from there. So they're able to revise these numbers as they go along and change them as needed. So it's an extremely powerful tool that we have. And the good news is too, is word seems to be spreading around the state about its effectiveness, because now when I'm meeting with participants, I'm starting to hear more and more tell me, hey, Brian, you went with one of my colleagues a month or two ago, and they mentioned something about this retirement review that you did with them. Can you do this with me? So this is something, no matter where folks are on the retirement spectrum, whether they're newer employees, whether they're folks just on the doorstep to retirement, we try to do this retirement review with everyone, with as many people as possible, because it really is a great tool for people to be able to see what their future retirement looks like with all these different sources of income added up together. So that's pretty much the quick and easy field report. If there's no questions, Gabe, I can turn it back over to you.
I don't have a question, but I do have a comment here. I think it dovetails with what Gabe said about participants staying engaged. And Brian, your report of meeting with participants, I've in the office, I've seen the reps available for meetings, and I've seen people using the reps and engaging. So appreciate that the help with participants, guiding them through the volatility and looking out towards the long term. So I've seen that with my own eyes, and I appreciate it.
Absolutely, yeah, our pleasure, Eric.
Eric, thank you so much. That's very nice of you to say so. And yes, that gives these guys a lot of encouragement. That's what they do. Our goal hasn't changed. How do we help participants achieve better financial outcomes? So that is the goal in everything we do. So thank you for that. Any comments from anyone else with respect to the presentation, for myself or for Brian or for any members of our team? Well, then, on behalf of all of us at Empower, Jay, I love that smile, Jay. There you go. On behalf of all of us at Empower, thank you for the opportunity to serve you, your participants, and obviously your retirees, and of course you as a board. So we really appreciate your visits. Thank you so very much. And it is a privilege working with staff, Tim and his staff, and of course RVK and Sarah and her staff. So it's a wonderful partnership, and we're very appreciative and grateful. So thank you for that. And Mr. Chairman, I will turn that back to you, sir.
Well, thank you so much, Gabe, for that report. It's always nice to catch up, look back on the quarter. So thanks again. Sarah, it looks like RVK and your investment review is up next. Can I pass it over to you, Tim? Would you like to say anything, or just right to Sarah?
No, I think we can get right into Sarah.
Okay,
thanks.
Great, Sarah, the floor is yours.
All right. Good morning, everyone. I have a few things to get through today, so I'll keep my comments high level, but please, I am trying to leave a couple of minutes for any questions or comments or feedback, especially on the watch list review that we'll present to you all at the end. So overall, high level, before we get into the planes, the as given team noted, definitely challenging Q1. Not only the US is really strikes on your own, but also there has been investors started repricing technology stocks, and there were a lot of concerns around AI, which certainly didn't help. Despite all that, if you look at the quarter-to-date performance, I think the S&P was definitely down for more than 4%, but the Russell Small Cap Index was up, and which is interesting and really good to see. And the reason behind the small cap outperformance is the economy. Small cap companies tend to get the majority of the revenue from inside the US. So, and on the economic front, things have been really coming along. We've had a reasonable growth and inflation despite the uptick in inflation. It's really in the still in the 3% zone. I think we are definitely expecting more inflationary pressure going into the rest of the year, especially if we do see continued tension and hostilities in the Middle East. So so that remains to be seen. But outside, if you strip out the oil and the energy pricing, I think inflation is generally within a reasonable range. Unemployment is still at also close to 4%, near record lows, and despite we're seeing more economic pressure and on consumers and on the lower end of the income spectrum, and that's something everyone's watching closely, but the overall consumption picture is still healthy as a whole, but it is something we're monitoring closely. In terms of, I think we get a lot of questions on inflation and how that may impact and is potentially going to impact portfolio performance. And we think this is a nice chart that really draws a parallel between the inflationary episodes of the 1970s, which are most relevant now because they were supply driven as well, similar to the pandemic period and the current Iran period as well. So the charts really overlay the annual CPI inflation and the rolling 3-year returns of the 60/40 portfolio. And you can certainly see that when inflation is beyond a certain range, I think it really hurts performance of equities and bonds together at the same time. And really, 60/40 portfolio is pressured in those top environments. We're happy to see that with inflation where it is now, definitely 60/40 portfolio is generating healthy low to double-digit returns at this point. But we are certainly watching the current situation with the Strait of Hormuz and hoping to see kind of end of that blockade and soon on both sides. And was really a lot of economies, especially emerging economies, really depend on that supply for essential resources and not just oil. So overall, on the market side, I think, like I said, US large cap was under pressure. Small cap did well. Another market that was certainly like a bright spot was international equities, where they underperform. They generated negative returns, but they certainly outperformed US equities as well. And that is kind of speaks to the value of diversification, having a mix of different investments. Bond also held up pretty well and were nearly flat for the period. So kind of like Gabe and team said, I think it's important to remember that DC plans are long-term investment, saving and retirement vehicles for participants. So keeping an eye on long-term outcomes is important. We generally see across our plan base that, especially within those who are invested in target date funds, this cohort tend to make very little movement within investments because they know they are diversified, they are invested in a portfolio that will dynamically react to markets and keep them on course for good long-term outcomes. And we're not seeing a lot of activities in DC plans either, but it is definitely something to keep an eye on. And actually, in just a minute, I'm gonna talk about your zero price target date funds, and they have done beautifully this quarter in Q1 relative to the benchmark and also many peers in kind of preserving capital, taking a more conservative stance during this time period, and it really helped their performance. So if there are no just general market comments, we can turn to just a quick plan update, starting with the single deposit investment account.
One question,
Sure.
Sarah. If you look at page, it's small on my screen. See the page 11, the bottom left quadrant with valuations. How do you all at RVK, when you're discussing this graph, what are the discussions like? I mean, you see the valuations of large cap literally off the quartiles at 37, 38 times. What are the discussions like around that? Is that I'm sure it's AI driven, but I mean, what about the sustainability of those valuations?
So this is actually it's eternally hot topic within RVK. So I think there are two main camps. Certainly, valuations are stretched within large cap, and they have been more so last year. And now with markets rebounding, I think we're seeing in some companies, in some spots of the market, valuations being stretched. But these valuations you're seeing on the charts, and I think you alluded to that, are based on historical earnings, not forward earning expectations. When you actually look at pricing to forward earnings or market analyst consensus on company earnings, they actually look within bound of history. And a lot of that speaks to a lot of good expectations that earnings will continue to grow at least over the next 5 to 10 years within areas of high growth that are going to see a lot of productivity boosts from AI. So there's a lot of that baked into markets expectations, but at the same time, I think concerns are valid that if you look at certain pockets of the market like small caps, these are certainly not priced to appropriately given the value and given their earnings and given their growth expectations either. So we really think market participants can benefit from diversifying more, but also at the same time, we don't think alarmist concerns around that this market will crash over the next 2-3 years and these valuations are kind of crazy and completely detached from reality. I think it speaks to something that we are seeing being fulfilled by companies' earnings this year so far. Actually, this quarterly earnings season has been great. 85 to 90% of companies have beaten analyst expectations, which is above average. They generally do beat them, but I think that has been above average. So markets are healthy, and we're seeing a lot of growth potential, but there are a lot of investors that are overly invested in one market, especially the S&P, and that we find concerning within this plan and within many other plans that we work with. An S&P index fund is the most popular option by far. And we find that concerning when there's someone who has all their savings just in one fund, because there are going to be periods of time where certainly the S&P will underperform other indices. And that's something we've seen this quarter, and we've seen a little bit of that last year as well. And we do expect a lot of growth potential outside of US large cap going forward. And so we like to see more diversification.
Thank you. That's really helpful. Yeah,
of course.
I appreciate it.
So if there's nothing else, just very briefly, like Gib said, I think the SDIA continues to see balances declining. It's fully invested in the Vermont Stable Value Fund, which we'll touch base on just in a short while, talking more about this one. On the Vermont deferred comp plan, we're seeing a small decline in balances driven by market volatility and returns. But you're actually seeing a growth in the participant count within the plan. So it's definitely from the enrollment standpoint that things are remain healthy. As I said, the institutional index fund is by far the most popular option, holds about 18% of assets. It has actually seen growth in participation over the quarter. So maybe some people were actually buying the dip during the quarter. In terms of how participants are using the plan overall, if you look at everyone who's invested in asset allocation fund or service, it's about 60% of the plan in either the target date funds, managed accounts, or goal maker. That 60% is in line with peers. Of course, we tend to see more target date usage in many of your peers. Couple of things worth noting here. Managed account usage did see an uptick from 7 to 8%, about 72 participants over the quarter. We saw a decline in those who are self-managing their portfolio of about 58 participants. So we are seeing a continuation of the shift toward more guided approaches within the plan, especially managed account and goal maker. A couple of comments on stats from high level cash flows. We always like to keep an eye on inflows versus outflows. And as we've seen in prior quarters, there's been just a bit more outflows than inflows within the plan. You certainly have a healthy active population, but there's also a not insignificant minority of participants who are terminated and hold balances, especially in those older cohorts, and who tend to have higher balances. So when those leave the plan, this leads to disproportionate outflows relative to inflows. So something a lot of plans like to keep an eye on. Retention really is healthy for plans. It lowers the cost of investments, like we said earlier. It allows you all to offer better services to participants. So something we're watching as a whole. And then finally, we are also watching managed account usage. Across cohorts, we still are seeing higher penetration across those younger participant cohorts. Overall, nothing significantly changed from what we saw last quarter. With that, switching to performance, any questions or comments? All right. So overall,
I see Lucas has his hand raised. Lucas, please.
On that last slide, yeah, it had the number of people terminated. So you had the 4. That page right there. Yes. So on the upper left, when it says terminated participants with balance, what is the 1,278? Like, what causes that large of a decrease?
Right. So what? No, thank you for your question, Lucas. So what we're showing here on this chart is basically a breakdown for each of those age groups. How many of those participants in the group that are either separated and still have a balance with Empower and the 457 plan, or still active employees with the state. So as you would expect, within the 67 plus cohort, the majority of them are separated from employment.
Okay, so terminated just means left state service.
Exactly. Yeah, and we can update that to make it more clear. Thank you for that question. All right. So on performance from a high level, given what we all talked about with the market environment, so you'll see manager results here on the pages here in the report that really align with what we saw in the market. Large cap exposure faced headwinds, international value, small cap held up very well, or even gained during the period. 3 of the managers are currently on watch. So Vanguard US Growth, Impacts Global, and the Stable Value Fund. You'll see them flagged on the dashboard, and I'm sorry about the small font here. Try to put all the things on one page. So those 3 managers are currently on watch. So I'll skip over them in this section so we can cover them in more detail in the watch list section. Lucas, for your benefits, this monitoring dashboard is broken into qualitative and quantitative indicators that we like to review each quarter. The idea here is to kind of hit the main key areas of change or that we think are worth monitoring. But of course, we encourage you all to review everything else in the report just to get a richer perspective on the plan. So overall, on the qualitative side, we flag here any organizational or strategy changes that we think are important or could be potentially adverse or impact future performance. We also show fees relative to peers. We show the RVK research rating. Positive means it's the best idea. We recommend neutral means institutional quality, but not necessarily a top pick. And anything flagged here means that this is a change that we need to focus on. And then on the performance side, for active managers, we're showing active excess return of the manager relative to their benchmark over the 3 and 5 year periods, and the peer group rankings over the same periods. A rank below 15 means you're outperforming, and then above 15 means you're underperforming. And then the color boxes on the right show rolling 5-year peer rankings. Green is basically good, yellow is a miss on one of the 2 dimensions, the peer or benchmark rankings, and then red means it's a miss on both. For passive funds, peer group rankings are not relevant since they are trying to track their benchmark. So for passive funds, it's either green or red. So overall, your target date series, you offer 5 vintages. They are all positively rated by us. And no important concerns there. We view this series favorably and it's done well for you all. If you look at the quarterly performance later on, they've outperformed, as I mentioned earlier, their benchmark for the most part and did well relative to peers, given their more conservative stance. The red you see here for their performance compared to the benchmark is simply because they have decided to tactically lower their risk exposure relative to their own strategic benchmark, which meant they underperformed slightly during up markets, but overall done really well relative to peers. All your passive options also are in good standing, tracking their benchmarks within normal range. One manager to call out is the FTSE Social Index. This is showing red here on the page because just its tracking relative to the benchmark was slightly above our range by just 1 basis point, and it's really not because of their tracking. It's just mainly because of their fees being slightly higher because it's a social ESG focused index, so they tend to have slightly higher fees, but no concerns with them at all. Within your active US equity funds, the only fund worth highlighting here was the Tiro small cap stock. They did have a transition in early 24, a full change in their portfolio management team. That's why we're keeping a closer eye on them and look at them just to make sure they do well. Doing forward, they have outperformed peers, but performance relative to the benchmark has been a bit challenged. No concerns with them overall. Within international active equity and global equity, beside impacts, which we'll touch on later, no concerns with either one of your 2 options. For the active fixed income and stable value funds, no concerns either. I think the only one maybe quickly to point out is for PIMCO Total Return ESG institutional. This one has really struggled for a few years, but we saw strong performance over the last couple of years, and they have rebounded significantly. So we're happy to see that rebound, and their near-term rankings are much better than their longer-term rankings. And then finally, the only one I want to touch on also here within the balanced category is the Impact Sustainable Allocation Fund. At our last meeting, we highlighted that this strategy actually, despite how they look on this page, they have, if compared to a 60-40 global benchmark, they have outperformed in 8 of the past 10 years, but the last couple of years have been really bad for them. They have underperformed significantly, and this has hurt their rankings, as you can see on the page. We are watching them closely to make sure that they do rebound. We talked about there has been softness overall within the ESG space. Any manager with an ESG tells, and the impacts platform overall has been underweight mega cap, and this hurt their performance. So don't think that they need to get on the watch list just yet, but we are watching them closely, hoping that we see some improvement in performance soon. So I'll pause to see if there are any comments on managers before we move on. Just briefly on cash flows, nothing to point out except that we did see a slightly small outflows from equity managers into as a stable Vermont stable value fund and other bond funds, which is I guess something you would expect, like the Vanguard Dual Bond Market Index Fund. Some small outflows from target dates into core menu options, which is consistent with what we saw with managed account and uptick in usage. Nothing overall that is concerning with the managers or the plan. So that concludes all my performance report remarks. Any questions or comments before we turn to the watch list? All right. So hearing none, I'm gonna briefly touch on I know we're close to time, so I'm gonna briefly touch on the first two managers on the watch list, and so we can spend, if we still have a few extra minutes, Tim, can we, I know we're at time right now, so.
Yeah, no, I think it's worth spending a couple minutes on the stable value, particularly if you want to move quickly through the first two, I think.
Okay, perfect. So we'll do that. So the first two manager, nothing I think worth mentioning here. Vanguard US Growth underperformed over the last few years, which is what drove the placement on watch. There has been no changes over the quarter, and we continue to recommend they stay on watch. I'm sorry, that's the Impacts Global. So they have underperformed over the last few years, which is why they are on watch. And there actually has been one change this quarter that I'm going to point out briefly, which is a change in their portfolio management team that we are monitoring closely. So on the Vanguard US Growth side, they have been placed on watch because of a manager transition within two of their underlying sub-strategies. No changes this quarter. We continue to recommend both of them being on watch. Turning to the State of Vermont Stable Value Fund, just as a reminder, this one has been placed on watch not because of its performance. Performance has actually been pretty strong, but because of organization investment team changes over the past 2 years, multiple consecutive changes to the investment team, the leadership, the CIO changed, I think, 3 times over a 2-year period. The fixed income team leadership changed, and a lot of senior figures. So that drove their placement on watch. We have been meeting with them several times over the past 12 months, including as recently as 2 weeks ago. Conversations were really productive, but we didn't really feel that we were able to fully resolve all our concerns about the organization and the turnover that they're seeing. They are still seeing significant turnover or loss of clients because of the record-keeping side business losses, which is impacting their stable value business. So we used this last conversation to kind of probe them on the mechanics of what an exit from this fund would actually look like. Not because we decided it's time to exit, but because we think it's prudent to understand how liquidation could work because stable value funds are different from other funds given their insurance wrapper. So the answers they give us were very reassuring on the operational side. Standard process, Mission Square requires a 12-month notice period ahead of any liquidation. So participant transactions continue at book value throughout the period after you give that notice, and then 12 months after you are able to fully liquidate your assets at book value. The eventual settlement would be in cash. There is nothing concerning about the process there. So, so we were happy with that conversation. And Stefan and Vicky have discussed, and we think that given the continued organizational uncertainty and just the accumulation of different concerns with the sustainability of the strategy, we think it's prudent to issue a formal 12-month notice of intent to redeem potentially from Mission Square. And to be clear, a redemption notice is not binding and it can be rescinded anytime before the end of the 12-month period. So we have to confirm at the end of the period that we do want to redeem. So there's no obligation to follow through with the redemption. This is simply a way for us to keep our options open while we complete our due diligence, because of just the design of stable value funds being how it is, and the way they require this 12 months notice before you can exit the plan. So we think we would rather have this option to do that later if, for example, within 6 months, we reach a conclusion that we do want to redeem from the fund. We want to have the ability to act on that at the time, instead of waiting for another full year before we can do that. And so we would like to just start the clock, preserve this ability for us to do that in the future. But to confirm, Stefan and Vicky are not recommending termination at this time. This is more of an operational step that we think is prudent to take. So Tim, anything you want to add there?
Yeah, and Sarah, thank you for that. I think, you know, when we look at this, we think that this is something we can do at the staff level. Obviously, we want to let you know about it before we intend to do it. But we view this as basically continuing our watch of the fund and our due diligence on looking at it, and just getting in line while we do it, so that we can, you know, if we do see cause to terminate, obviously that would be a board decision, we bring it back. But right now we're planning on managing this part of the process at the staff level, coming to you with further updates each month to let you know or each quarter where we are.
Yeah, no, thank you, Tim. So if there are no concerns, I think we'll proceed with this is our plan of action here. There's no downside of that. And what we'll be doing, like Tim said, we'll report back to you all with updates at the next quarterly meeting. And we may potentially bring a recommendation, either to remove them from watch or to redeem. Bill, did you have any question?
Your question?
Yeah, I had an observation. This is John. I'm looking at page 19 of your previous report, and this is a very, by value, it's 14.36% of allocation. That's what that chart is showing me here. I guess it's been updated to 14.58%. So this is 5,900 members that are going to be affected by some action that we might take after that year period. Can someone run through what that would involve, and what are the alternate stable value programs that we would consider?
Yeah, well, great question. And yeah, you're exactly right. I think we understand this is a significant part of not just this plan, but across the supplemental plans. This fund, as all stable value funds tend to be, they tend to have a lot of participant assets in them, which is why we think taking a prudent, methodical process here to evaluate our options before taking any action is very important, and we wouldn't take that lightly or make any recommendations unless we really think that's in the best interest of participants. But to your point on how that would work, for stable value funds to kind of fully preserve assets, they request having this 12-month period in order to guarantee that you will get all your assets at book value, meaning you put $1 in, you get $1 out with any additional yield that the stable value fund generates, as opposed to getting market value, and market value, as you know, will move up and down with interest rates in the marketplace, the way money market funds do, for example. So this 12-month, waiting this 12-month assures that we will get our book value plus the yield, and participants will not be losing any value as a result of any potential change. And with that, the book value would essentially be mapped to another stable value fund or other capital preservation option if we do make the decision to terminate. We have a 12-month period to evaluate our potential next steps. If we want to do a search, potentially, we have a lot of time to kind of go through that process, methodically review, implement liquidation options, and then review potential managers, discuss them, and make sure that we are very comfortable with that decision before we pull the trigger. Because like you said, this is a significant investment here, and this is a decision not to be taken lightly. Hope that helps.
John, we just went through this process not with a stable value fund, but with one of our other funds in the municipal and state DC plans. And just what this looks like, sort of on a nuts and bolts manner, is that RBK does sort of a book that identifies a handful of alternatives that are comparable to the existing funds, but that have carry a higher rating from RBK. And they kind of compare them on a number of metrics. We provide this to the board along with a recommendation about what an alternative might be. But that's all sort of down the road from where we are now. There are other alternatives that we can look at. For now, we're not at a place where we're recommending action. Our plan is to get in line to preserve the opportunity for quicker action should the board want to do that. But for now, given particularly given the turnover at Mission Square and what we're seeing in the organization, we think it's prudent to just take some, to get an umbrella right now, and bring it along with us in case it becomes a rainy day, and then we'll be able to perform all of the other tasks and present them to the board in a orderly manner, so we're not in a place where we're nervous. Does that help?
Yeah, thank you. I'm learning as I go along, and I'm looking at the page. I don't know if this was presented or not, but it's in the investment manager pages. It's basically all insurance and the top wrap providers. So another stable value fund would be similar to that kind of profile, I would guess.
Yes. Are you referring to this page by any chance?
Yes.
Yes.
Page 51.
Correct. So options are, I think there are insurance guaranteed capital preservation options, but there are also other options like money market funds that have no insurance guarantees. And it's certainly something worth, if we go down that path, it's worth having a discussion of the trade-offs of going with either one of those options.
Yeah, and
Okay.
If you recall, I want to say this was in the fall, and it was in response to a question about a year ago from Commissioner Gresham about, thinking about money market funds in lieu of a stable value account. So Sarah put together a deck on that, and I can have Bill, if you could recirculate that to the board, that deck after the meeting today, that might be a helpful sort of reorientation, at least to the different fund types that are available for capital preservation.
Absolutely.
Thanks so much.
Yeah, thanks for the question. Thanks, Tim, for bringing it back. I was recalling that conversation as well. I kind of view this as sort of keeping our options open, so that if we feel like we can make a change, we can do so. Thanks for putting this on our radar and doing the due diligence on what we should be thinking about while we're evaluating our options.
Yeah, of course. And yeah, I echo that completely. I think just given the design of those funds, it's helpful to be thinking ahead and keeping our options open. So, but I do appreciate the question and engagement as usual. I think this was actually the last item we had on our agenda for you today.
Yeah.
So unless there are any other
think
questions, I think Jay.
I see hand
Yeah.
from Jay.
Yeah, I'm just wondering if right now we have this stable value fund as the one capital preservation option in our mix. So is there any consideration to adding a second option that would also be a capital preservation type of fund?
No, that's a great question. And we do see some plans offering two capital preservation options, for example, a money market fund and a guaranteed option like a stable value fund. And there can be merit to that. But there are considerations. Some folks may be confused about the differences. We may see usage split between the two. There are certainly pros and cons there to the extent of allowing more flexibility to the users. I think that participants that could make sense. So that could definitely be something to also consider down the road. I think what we see more often in some plans where they offer a guaranteed fund that has a 3 to 5 year put, and we tend to see that with other options, not stable value funds, but like general insurance guaranteed general accounts, like more closer to the Empower guaranteed long-term fund and some of the other plans, is they tend to have a longer put period. So some plans would offer a new fund as an alternative for new contributions while closing the old fund to contributions as it redeems and as it liquidates. So that's an option we see also sometimes that we could also discuss, I think, down the road if we need to. Does that help? Yes. No, thank you for the question. I think great discussion overall, and gives us a lot of things to think about as we think about next steps there and continue our due diligence. Thank you all for the feedback.
Thank you, Sarah and RBK, for your work and sharing that with us. Tim, it looks like the next item on our agenda is the legislative update. Tim, I assume you might want to take the lead on that.
Yep. And we'll run the rest of this pretty quickly, I think. Just wanting to give a brief update on where we are at this point. Rumor has it that the legislature is looking to get out, at least initially, by the end of next week. So things are wrapping up over there. With respect to our items, the one we're tracking the most closely is the Treasurer's Office Omnibus Bill. That really has two primary components for the retirement systems that we're really interested in. First is that task force on our funding policy, looking at our closed amortization period. And the second is the transfer of OPEB investment authority from the treasurer over to VPIC. Both of these items and the bill generally have gotten a favorable reception in both bodies. And we're hopeful that it's going to be coming out of the Senate soon. I think there are some issues folks are talking about related to something that's not related to the retirement systems, but generally all the retirement provisions have been received very favorably over there. So hoping that gets out and across the finish line, and I've started already thinking about what, excuse me, some of the work of the task force might look like. The budget is looking good as well. All our funds for the ADEX are in the budget. There are a couple smaller provisions that in the Senate side came in. One was the positions for both VPIC and the retirement division are in the Senate version of the budget. There was, we think about it as waterfall language. At the end of the fiscal year, there may be extra funds. And in Act 114, there was a dedication of 50% of those funds, 25 to the teacher system, 25 to the state system. And that language was initially not withstood, but in the Senate version of the bill, I think that's coming back. So the Senate version of the bill is consistent with the Act 114 intent. So happy to see that. And the one other thing that we asked for in the budget at a late hour was there's a reserve, and what I'm informally calling an ADEC reserve for the teacher system to account for falling off federal grant revenue on that side. So there's some money that is put aside to make up for that lack of revenue for the teachers ADEC. And after we talked to our accounting team, they thought that we might not need all of that for the teacher system, and we may need a little for the state system. So the Senate version of the budget authorizes any leftover amount to be used for the state ADEC as well, which is good because it'll make sure that there's funds available to meet the total ADEC. Last thing I'll just highlight is there was the H519, which was the bill that does what I believe will be our final Group G expansion, and it will just allow those handful of towns that are in our system that have law enforcement officers to participate in Group G. So it's very similar to what we did for deputy sheriffs a couple sessions ago. And this one is incredibly small. We expect it to impact 3 people because only Randolph has a police force, and my understanding is they only have 3. So this is incredibly de minimis, but it does, I think, wrap a bow on sort of the Group G discussion. And that was just signed into law this week. So those are the main things that we are looking at. Defer to anyone else on the call if they have any questions or if they're looking at anything over in the legislature at this point.
Not seeing any other takers. So thanks, Tim, for that update. Last item on our agenda is any other business to come before the board. It looked like you wanted to speak to something there, Tim.
Yeah, and I just wanted to highlight for board members, we're expecting next meeting to have our experience studies. Obviously, it's a once every 3-year study. It's really important. I'm expecting to get first look in a week or 2 from the team at Siegel. What we did in the materials for this meeting is we put the last experience study in there, just so I think it's worth just taking a quick page turn to recall what we did in the past study. And if you recall, that was the experience period was very COVID heavy. So, we were taking a deliberate wait and see approach. I think we made some changes, but, maybe weren't really sure how much we could rely on some of what we were seeing. I think we'll see some changes here. I would expect to see some additional liabilities from this experience study. Inflation has been, long-term expectations of inflation have been persistently high. So VPIC will be meeting on the 26th to address that piece. Retirements have continued to come in high. So I wouldn't be surprised if we tighten that up. And, you recall when we tighten up, it adds some liability. So it's a really important study. And if anyone wants to talk experience studies in advance, happy to. If any questions, but wanted to put that material in front of you. This will be the first time a number of board members have seen an experience study, just to orient and get ready for next month's discussion. So just a flag there. Any questions on that, Mr. Chair?
I was going to hit on that topic too. So just more of a comment. So thank you for including the past experience study as context. The liabilities are just generally made up of demographic assumptions that are driven by the makeup of the participants and their actions. That each system looks at, and then the economic assumptions. VPIC takes the lead role by statute now on that, and we did have. I just want to highlight VPIC had its annual meeting. We don't really take action on stuff. It's meant to take a step back in training and look at some broader concepts versus really being very investment decision focused. and there was some discussion about inflation there. And I think we'd see it's safe to assume that estimate might move up, but that will be a topic of EPIC's May meeting, as Tim said, which is to. And Tim, now you're serving on that role, on that board, on that commission actively. So I think that's really helpful to have the connection to the systems in there too. So more to come on that, and more to come on the experience studies. But thanks for teeing that up for us.
Sure. And I'm just going to take one last moment to highlight just a kind of nice story from inside the office. We recently, as many offices across the state, celebrated Public Service Appreciation Week. We had ours this week just to accommodate some scheduling differences. So we had a lunch with the team yesterday, and very pleased to report that our Chief Retirement Specialist, Don Netto, was recognized by the office as Employee of the Year. It was due in large part to things I pointed out to this board before, but a lot of the work Don has done to really get out in the community, get out in the agencies. So both whether it's our participating employers in VMERS and VSERS or all of the different agencies throughout the state, Dawn and her team have been making a really determined push to just get out and talk to our employers, talk to our members, make sure that our benefits are understood. And so seeing that recognition by office leadership was really rewarding. And I think it's a testament to the work that she's doing here. So just wanted to highlight that for all of your attention.
Thank you.
Thank you, Tim. That's really nice. Appreciate that update. Congratulations to Dawn too for her hard work.
I'll pass that along.
So with that last agenda item, any other business? Do any other board members have any comments that they'd like to make on this agenda item? Not seeing any at the moment. We might be ready for another motion here. What's the board's pleasure?
I move that we adjourn.
I'll second that motion.
Thank you. With the motion and the second, the item is on the floor to adjourn. There's no discussion on that item. So all those in favor of adjourning, please signify with an aye.
Aye.
Aye. All those opposed with a nay. Hearing none, the ayes appear to have it. The ayes do have it, and the May meeting of the Vermont State Employees Retirement System is adjourned at 10:25. Thank you all for joining us and participating.
Thanks,
Appreciate it.
Thank you.
Be well,
everybody.
everyone.
Be well. Bye-bye.
Take care.